Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into a significant development in the mortgage market. Canadian households took on a whopping $9.1 billion in new mortgage debt in April. That's quite a substantial figure, don't you think, Janine?
Absolutely, Steve. It's a clear indication that despite the challenges, Canadians are still pursuing homeownership with vigor. What stands out to me is how real estate secured debt, which includes both mortgages and home equity lines of credit, grew by $9.9 billion that month. It's a testament to the value people place on owning a home.
Yes, and looking at the numbers, the year-over-year growth in mortgage credit hit 4.7% in April. That's the fastest pace in 2 years. It's quite a rebound from the post-pandemic slowdown, wouldn't you say?
Indeed, Steve. The fact that the increase was one of the strongest for an April in recent history is telling. At $8 billion, the monthly increase was higher than the previous Aprils in 2023 and 2024. It shows a growing confidence in the market, which is encouraging for both homeowners and the industry.
Exactly, Janine. However, it's interesting to note that while mortgage debt surged, non-mortgage credit growth has slowed. It was at its weakest pace in months, with only a 0.1% increase in total debt in that category. What do you make of this disparity?
I think it reflects a cautious approach among Canadians when it comes to other forms of credit, like credit card debt, which actually edged down by 0.1%. People might be prioritizing their mortgage commitments over other types of borrowing, which can be a wise move given the long-term benefits of homeownership.
That's a good point. And while non-mortgage credit growth eased to 3.9% annually, borrowing by private non-financial corporations fell sharply. Their total credit liabilities dropped by 0.9%, largely due to a drop in debt security liabilities. It seems there's a broader trend of financial caution beyond just households.
Yes, Steve, it's a complex landscape. But ultimately, the surge in mortgage debt underscores the enduring demand for housing in Canada. It's something we'll be keeping a close eye on as we continue to track the trends and provide insights on this podcast.
Let's shift gears and talk about why the Bank of Canada decided to hold its policy rate steady in June, despite the rising risks in the economy. The Governing Council debated a 25 basis point cut, but ultimately they chose to maintain the policy rate at 2.75%. What do you think about that decision, Janine?
It's an interesting choice, Steve. The decision seems to stem from the fact that inflation hasn't cooled as much as the bank hoped. Though the headline Consumer Price Index was down to 1.7% in April, largely due to the removal of the federal carbon tax, core inflation remained sticky. Excluding the tax change, inflation was at 2.3%, and the bank's preferred core measures were running above 3%. It shows a cautious approach from the bank, wouldn't you agree?
Absolutely, Janine. Inflation is a key concern, and the bank noted that cost pressures tied to tariffs and supply chain changes were contributing factors. Some members of the Governing Council were particularly worried about the increase in the breadth of Consumer Price Index components, growing above 3%, especially for services. It's a complex situation where the bank needs to balance inflation with maintaining economic stability.
That's right, Steve. Despite signs of a slowdown, the data didn't indicate a sharp downturn. The first quarter growth was slightly stronger than expected, thanks to exports and business investment, although the latter might have been front-loaded to beat tariff-related cost hikes. The bank noted that final domestic demand was flat, yet overall, GDP growth held up due to the resilience in consumption and business investment.
Exactly, Janine. But the Governing Council did express concern about emerging soft spots in the economy, such as weakening labor market conditions, particularly in trade-exposed sectors, and the unemployment rate rising to 6.9%. Residential investment also fell, with subdued housing activity in Toronto and Vancouver. These are areas to watch closely as they could influence future rate decisions.
And let's not forget the uncertainty surrounding U.S. trade policy, Steve. This was a prominent factor in the bank's deliberations. While global trade tensions have eased somewhat since April, the announcement of higher tariffs on Canadian steel and aluminum by President Trump added a layer of risk. The bank is closely monitoring how these tariffs might affect exports, investment, hiring, and prices.
Yes, Janine, the bank's decision to wait on a rate cut reflects three key developments: hotter than expected inflation, some resilience in economic data, and high uncertainty. While further cuts may be needed if trade disruptions deepen and inflation pressures ease, the bank saw little urgency to act immediately. It's a cautious approach, allowing more time to assess the impacts of U.S. trade policies on the Canadian economy.
It's a delicate balance, Steve. The bank is aware that if the economy weakens and inflation pressures reduce, there could be a need to lower the policy interest rate further. However, if underlying inflation remains sticky, cutting rates could be challenging. For now, the bank is opting for a wait-and-see approach, which could be wise given the current economic landscape.
The latest update to the Consumer Price Index basket is giving even more weight to shelter costs, underscoring the significant impact housing expenses have on the inflation experience of Canadians. Statistics Canada announced that the new CPI basket, based on household spending in 2024, will take effect with the May inflation data release on June 25, 2025.
That's quite a shift, Steve. It's a reminder of just how much of our income goes toward keeping a roof over our heads. With the shelter component now making up over 29% of the CPI, it's clear that housing costs are a major factor in household budgets.
Absolutely, Janine. The shelter component's rise to 29.12%, up from 28.57%, marks the highest level since before the pandemic. This reflects the pressure that housing costs are placing on household budgets. Two specific categories are driving this increase: mortgage interest costs and rent.
It's interesting to see how these categories have shifted. Mortgage interest costs rose to 5.65% of the basket, and rent climbed to 7.19%. It's a significant change, especially considering that the Bank of Canada began cutting interest rates in 2024. Yet many borrowers are still renewing at much higher rates compared to 5 years ago.
That's right, Janine. According to Scotiabank economist Derek Holt, the increase in the shelter rate was expected, driven by mortgage interest and rent, although partly offset by a decline in the homeowner's replacement cost component. This component, reflecting the cost of rebuilding a home, declined slightly to 4.64%.
And it's not just housing. The transportation component also rose to 17.29%, driven by an increase in the weight assigned to passenger vehicle purchases. Improved vehicle availability in 2024 helped drive auto sales higher, according to Statistics Canada.
Indeed, while some components like clothing, footwear, and recreation saw their shares fall, the overall food category remained steady. This is despite elevated grocery prices, with a modest decline in store-bought food offset by a rise in restaurant dining.
It's fascinating to see how these shifts reflect our changing spending habits. Though the change in weights might not dramatically alter the CPI itself, it does shift how much influence different price categories have going forward. With shelter now accounting for nearly 1/3 of the CPI basket, any swings in rent or mortgage costs will have a significant impact on headline inflation.
Exactly, Janine. Statistics Canada continues to update and enhance the CPI to ensure it remains the highest quality measure of price change. While the 2025 basket update incorporates weight and classification changes based on the most current expenditure data, it subtly shifts the landscape of how we understand inflation in Canada. The latest report from the Canada Mortgage and Housing Corporation reveals a significant downturn in condo sales in Toronto and Vancouver, while other markets show resilience. According to the report, Toronto's condo sales have dropped a staggering 75% since 2022, and in Vancouver, the decline is 37%. This downturn is attributed to higher interest rates, which have reduced affordability for home buyers and returns for investors.
It's a stark contrast to the previously hot market, Steve. Lower interest rates had initially attracted a lot of buyers, investors, and builders. But now, with the increased rates, many people simply can't afford to buy, and investors are not seeing the returns they once did.
Absolutely, Janine. The report indicates that the housing market is expected to grow overall, but the recovery won't be uniform. The condominium apartment market is lagging, especially in areas like Toronto, where many condo owners are investors struggling with rising costs and softening rents. In fact, over 80% of investors in new condos in the Greater Toronto Area are reportedly losing between $1,000 to $1,500 per month per unit due to these high interest rates and rising costs.
That's a tough spot for investors, Steve. With rent controls and a competitive rental market, they can't easily raise rents to cover these losses. It's a challenging situation that requires careful navigation.
Moreover, new condo construction starts have plummeted, down 79% from last year and 88% from the 10-year average in the Greater Toronto Area. This is the lowest level since 1996, as developers struggle to secure financing amidst record low sales activity. This is leading to project delays and cancellations.
It's concerning to see such a dramatic drop in new construction, Steve. But in other parts of Canada, the situation is different. Cities like Calgary and Edmonton are showing more resilience. The Canada Mortgage and Housing Corporation notes that more buyers are actual residents rather than investors, which minimizes the impact on new construction there.
Yes, Janine. In Alberta, the rapid price growth in Calgary and Edmonton's real estate markets is expected to level out because of rising interest rates. Edmonton might even see a surge in prices due to population growth and economic resilience, offering buyers more options.
And in British Columbia, while there are fewer investors and a stronger resale market, the slowdown in condo apartment construction is expected to be milder. The city of Surrey, for instance, is rapidly expanding and offers affordable properties and strong investment opportunities.
Indeed, the market dynamics vary significantly by region. The Canada Mortgage and Housing Corporation expects housing starts in Montreal to increase for a second consecutive year, although rental units will remain the most commonly built housing type. Meanwhile, in Ontario outside Toronto, lower demand for pre-construction condominium apartments is expected due to weaker resale and rental markets, leading to a slowdown in new construction in 2025.
In the long term, Steve, the Canadian housing market is expected to rebound as lower mortgage rates and changes to mortgage rules unlock pent-up demand. Stronger economic fundamentals, like improved job markets and income growth, will support this recovery. But the timing and extent remain uncertain, and we need to keep a close eye on how these trends develop.
Single-family home prices in Ontario are showing signs of stabilization after facing a turbulent period. According to the Canadian Real Estate Association, the average price of a single-family home in the province fell year over year from $946,300 in May 2024 to $889,700 last month, marking a 6% decline. Meanwhile, condo prices dropped by 8.3% and townhouses saw a 6% decrease.
It's reassuring to see some stability returning to the market, Steve, especially after the uncertainty caused by tariff threats from the United States. The tariffs had cast a shadow over our economy, leading to a slowdown in the real estate market. But now, with prices holding steady, there's a glimmer of hope for homeowners and potential buyers.
Indeed, Janine. The Canadian Real Estate Association's senior economist, Sean Cathcart, mentioned that May 2025 saw home sales increase nationally for the first time in over 6 months, and prices stopped falling. He noted that while it's only 1 month of data, it suggests that the expected turnaround in housing activity might have been delayed by the initial tariff chaos.
That's an encouraging perspective, Steve. It's a reminder that sometimes patience is key in these situations. The housing market is resilient, and while the road to recovery might be gradual, these signs are promising. It's important for homeowners and buyers to stay informed and make decisions based on these trends.
The Greater Toronto Area, Calgary, and Ottawa experienced the most significant increases in home sales volume. However, within Ontario, areas like Sault Ste. Marie, Sudbury, and North Bay showed stronger price growth than other regions. For instance, Sudbury saw a 6.7% increase in single-family home prices year over year, which is quite noteworthy.
That's great news for those northern communities, Steve. It highlights the diverse nature of our province's real estate market. While some areas may struggle, others thrive, reflecting local economic conditions and demand. It's a testament to the resilience and adaptability of these communities.
Exactly, Janine. The Lakelands real estate district also saw some changes, with single-family house prices remaining relatively stable, while condos and townhouses experienced minor declines. It's interesting to note how different property types react to economic shifts. This kind of data helps us understand the broader market dynamics.
And it's a good reminder for buyers and sellers to consider these nuances when making real estate decisions. Understanding local trends and conditions can help individuals make more informed choices about buying or selling property.
Let's delve into the recent news about Canada's population growth, or rather, the lack thereof. According to Statistics Canada, the country's population saw virtually no growth in the first quarter of 2025. From January 1st to April 1st, the population increased by just over 20,000 people, marking the slowest growth since the early days of the pandemic.
That's quite surprising, Steve. It's a stark contrast to what we've seen in recent years. The slowdown seems to be largely due to the federal government's efforts to reduce both temporary and permanent immigration. The number of non-permanent residents fell significantly, especially among international student permit holders in Ontario and British Columbia.
Yes, Janine, and Robert Kavchich, a senior economist at BMO, pointed out that this policy shift is leading to a major population adjustment. He noted that non-permanent immigration remained negative, with a net outflow following caps on international students and temporary foreign workers. Ottawa is aiming to reduce the share of non-permanent residents from above 7% to 5%.
It's interesting to see how these changes are playing out, Steve. Despite the reduction in non-permanent residents, permanent immigration remains solid by historical standards, with over 100,000 new permanent residents admitted in the first quarter. However, even this is down from recent highs due to reduced federal targets.
Indeed, Janine. The population losses were particularly notable in Ontario and British Columbia, marking the largest quarterly losses since data collection began in 1951. However, Alberta continues to lead in interprovincial migration, gaining over 7,000 people from other provinces in the first quarter.
Alberta's growth is likely influenced by affordability, Steve. As Robert Kavchich mentioned, affordability has been a key driver for migration to Alberta and Atlantic Canada. But with Ontario's prices and rents declining, this trend might be nearing its end.
That's a possibility, Janine. Looking ahead, Kavchich expects Canada's population growth to continue cooling, with net births also declining. He suggests that we might return to conditions similar to the pre-pandemic decade, with about 1% population growth and sturdy permanent immigration.
It's a reminder of how dynamic our population trends are, Steve. Understanding these shifts is crucial, especially for those in the housing market, as they can influence everything from housing demand to economic growth.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.